Well, good evening, everyone. Welcome to our second quarter market review and outlook. Really pleased to have you with us. We've got a great attendance on the call tonight, and so certainly appreciate you sharing an hour or so of your time with us to kind of run through our thoughts and observations about the market, certainly throughout the last year and the start of the year so far. Spring is definitely spring up in upstate New York, and we've had a really nice couple of days over the last week or so being out in the garden and the yard and kind of getting things ready. So hopefully you all have too. On the call with me tonight is obviously Audra, who almost all of you know very well. And we're going to be taking you through a couple of different thoughts tonight. You know, for us, we really believe that investments, as important as they are really just a tool in the context of a bigger financial plan and a bigger financial planning picture. And in the financial planning world, Audra, we've had quite a few changes over the last couple of quarters with the introduction of what's called the Secure Act 2.0. So we thought we'd start off there tonight, setting context with just some kind of high-level important things that people on the call should be aware of and know about. And then we'll spring forward there into the more investment-focused piece of the evening. So, Audra, why don't you kind of get going for us?
All right. Well, welcome, everybody. As you might remember, in 2020, you might have even participated in a webinar I did with Don when the Secure Act first came on the scene, and some of you got to participate in some of those changes. But now they've continued to take it up a notch. So now that we can all happily say, for the most of us, that the tax season 2022 is in the rearview mirror, it is not too late to get started on 2023 and taking full advantage of opportunities that have now been presented to you. So the first thing we want to touch on is the revised required minimum distribution ages. So for those on the call that haven't yet gotten there, or some of you may already be there, we wanted to spell out, based on your birth year, what the age is that you will need to start participating in required minimum distributions. So as you will see, born July 2nd, 1949 through 1950 is age 72. Everyone prior to that is bound by the original date, which was age 70 and a half. Then you will see those born years 51 to 59, age 73. So you may have even been someone that this year we're gearing up, ready for us to send you your first required distribution, but at the very last minute, we were able to kick that down the road to next year. And then lastly, for all of those born 1960 and forward at this time, your age will be 75. So for those that are in some of those latter brackets, all the more reason getting back to planning is always the focus. There are extraordinary reasons to take advantage of that extended timeline to look at the distributions you need to take and the options you have to work on tax strategy and estate planning in the interim. Next, we wanted to focus and highlight some of the particular catch-up contributions that are now being expanded upon for those that are ages 50 and older. And again, keeping in mind, this is referring to those that are still working. Making contributions to retirement accounts are based on having earned income. And for those entrepreneurs that are big into real estate, passive income does not qualify as earned income for reasons of contribution. So just a little disclaimer there. So this year in 2023, a giant step up. Historically, the catch-up contribution beyond the initial base was only $1,000. It has now been increased to $7,500. So with the base now being $22,500, you can add another $7,500 to cap out at $30,000. Now, keep in mind, this is only referring to your contribution as a participant. This is not inclusive of your employer match. So a wonderful opportunity to take advantage of. Starting in 2024, for those that have incomes over 145,000, these catch-up contributions will actually no longer be able to be made to your pre-tax dollars. They will need to be directed to the Roth. So certainly an equally wonderful opportunity. Will not bring you the same reduction of taxable income now, but in the future will net you tax-free dollars for both the contribution and the growth dollars. So keep that on your calendar as well. And lastly, in this category, we want to give you a really early sneak peek at 2025. They will be increasing contribution limits for those 60 to 63 to the greater of $10,000, again, on top of whatever that year's base contribution is, to $10,000 or 150% of the standard catch-up limit. So keep an eye. You will typically see around October, November, they'll already start to drip out what those levels are looking like so that you can take full advantage. And we will certainly continue to be proactive to keep you updated on what the levels are and how to structure participation. Okay, we want to talk about a couple other changes in the same arena, the Roth employer match. So historically, many of us have had opportunities that participate in 401ks to not only contribute pre-tax dollars, but also after-tax dollars to a Roth component. However, our employer match dollars were always given to the pre-tax side. Now, there is a provision for those employers that opt to participate that they can direct your matching dollars to that same Roth component. So you will need to correspond with your HR departments or custodian of your plan to confirm if they have deployed this new provision, but it does exist. There is an allowance for it. I am hearing some chatter that in some cases, they just haven't been able to react fast enough. So it may be introduced later this year or into next year, but at least we want you to know it exists and to make that inquiry. And lastly, that there will no longer be required minimum distributions for Roth 401ks. So of course, immediately you might have a giant question mark because we always are telling you, do the Roth, because there's no required distribution. But that was only relative to private Roth accounts that you might have. If it was a Roth inside of your 401k, you did still have some mandated distributions. But that is now being lifted. So for that reason and a lot of others, we're always happy to share with you, Roth 401ks are a wonderful, wonderful opportunity to participate. If you didn't do it in the early years, it's never too late. You can always turn on that other contribution faucet. So we hope that those are some interesting new opportunities, and we invite you to reach out and we can drill a little deeper on the nuances.
Thanks, Audra. That's really helpful. Bob actually just in that vein submitted a quick little observation that he said that his employer said that they've not yet received confirmation from the IRS as to withholding of Social Security and Medicare on the Roth match. So as usual, there's legislation put in place without yet the IRS figuring out how to actually administer it. So that's not super unusual, unfortunately, but worth continuing to kind of stick it in there, Bob, with your employer and see as soon as that's available. I think it's a pretty good option for most employees, but thanks for sharing that. Thanks, Audra. That's super helpful. And again, as we go through tonight, any questions that you have, there's a question and answer, a Q&A section at the bottom of your screen. Please feel free to submit your questions or your observations as we're going through tonight. Let's take a quick look at just kind of the general agenda of what we're looking at tonight on the investment piece of the outlook. At the end of the day, we always are going to rebalance clients' accounts at least 3 times a year and more frequently if necessary. Last year was a really unusual year where things were really kind of all up and over the place. And so we actually rebalanced more like 5 or 6 times and made tweaks and adjustments more regularly and in between the more pre-scheduled rebalancings that we do. But so far this year, we just recently in the last couple of weeks of March, first week of April, did a pretty major rebalance across our client accounts. And so the reason for tonight's session is really to shed some light as to what we did, why we did it, and just share with you some of our thinking in terms of where we're currently positioning client assets, which hopefully you can then apply to other assets even outside of our direct management. So here's kind of a very quick overview. Visually, look at our little dial here. As much as things have done relatively well so far this year, and there's definitely been some stabilization that's occurred across most of the markets, we're still actually positioned about 1 click down from neutral into the defensive range. And again, that might seem a little bit overly pessimistic, but I do want to share with you a couple of reasons for that outlook. Number one is still continued concerns over inflation. There's certainly some recession concerns, and also just, we're keeping a close eye on any kind of hidden dangers that may well kind of start to come to the surface as a result of the rate hikes that were obviously implemented over the last 12 to 18 months. So I'm going to have Audra jump through a couple of slides here on inflation, and then we'll kind of continue our path down, kind of explaining a little bit more about how we're positioned, and welcome any questions as we go.
Okay, so for many of you, this may not be a slide you've never seen before. Sadly, it continues to linger, but we will see what happens. So basically what we want to represent here is the concept that there are different types of inflation that we need to consider. Although when you first glance at this slide, you may quickly get excited to see the high level green rising inflation peak out at 9% and now be down to 6%, which certainly we don't want to diminish that being a positive sign. But first, let's take a minute and look at the different makeup of the overall inflation. We have both what would be considered transitory or short-term areas of inflation, which might be in red are vehicles. As many of you who are challenged with needing to find a used car or a new car for that matter, were fearful to give up your leased car because you didn't know if and when you'd ever see another one. That supply and demand challenge created some escalating inflation in that area. However, as you've already rapidly seen, that is virtually gone. And if anything, now there's more and more cars and less capacity for people to buy them. So they're contributing to deflation. So all of the things that you're kind of seeing in that upper tier are things that we confidently feel will be shorter term and will begin to subside. But the ones that really challenge us are the things that are below the line. These are the sticky or the longer term things. And the largest area that makes this up is housing. And for those that are renters, rental costs. You will definitely know that theoretically, if you're someone who is renting, that your landlord likely raised your rent recently. And as much as I'm sure out of human kindness, they would love to lower that, since of course we've all seen a reduction in inflation, I doubt that you've seen any refunds in the last couple of months' rent. So that is a very strong reason that we are really concerned about everyone getting too excited about some of the recent decline. Certainly happy that we're getting down in the 5% range, but if in fact the Fed's target is 2 to 3%, we really have a ways to go, because if you're watching that aqua arrow that's pointing up to the right, you're actually seeing these longer term areas rising. They are not declining. So they are pushing back up the reduction that we are gaining from the shorter term areas. So all the more reason that this is really leading us to think that this is going to be sustained for a period, and the Fed's hand will likely be pushed to reconsider a continuation of interest rate hikes. Let's take a peek at another slide that also helps to support our theory that inflation is going to linger. Trueflation is basically another resource that we look to in addition to the CPI reports that classically are reporting on the pace of inflation. Now, the Consumer Price Index, as you know, is basically giving us a reflection of over the past month what changes have occurred in the costs of goods and services. Although this is very beneficial information, it's really like getting your statement after the month is over. There's really nothing you can do proactively. What's done is done. So although it's helpful, this tool is actually drawing on a lot wider range of data that is enabling them to show a daily movement of the inflation rates. So, for example, if you really focus in the lower right corner, you will notice that in late March, probably the last week of March, all of a sudden, this steady path of decline started to turn. And now, as we're moving through April, it is going back in the opposite direction. So what's very telling of this is that it's not quite time to claim victory, that we have raised rates to a level that we can all just go back to the way things were. So this will continue to be a tool that we feel is very reliable to monitor day by day, month by month, and at least at this stage, feel confident that it's going to take us at least another couple of months to see where this trend line is going. Is this maybe just an off month and things resume the path they were on? It's yet to be seen. But for the time being, we definitely feel that we are preparing that there will continue to be raised rates. And we have taken our posturing as a result.
That's a great explanation, Audra. Thank you. And just one additional, comment there. Why does inflation matter? At the end of the day, it matters because the main reason that the markets have had such a tough time has been the rapid raise and the rising of interest rates over time in response to inflation. And so a large part of why the market so far this year has kind of stabilized and has actually recouped some of its losses have been really born out of optimism that in the battle against inflation is mostly won, and therefore the Fed is going to be able to stop raising and ultimately even cut rates before the end of the year. And again, I would just say, we're a little cautious to really claim that until we've already seen a couple more months worth of sustained declines in inflation moving forward. So again, just to reiterate why that's important is because the market is already kind of pricing in that the inflation battle has been won, and that ultimately in the coming months and towards the end of the year, we'll actually have rate reductions, which I'm not confident will necessarily be the case.
All right. And the next area that we wanted to focus on is the area of recession itself and why we feel that this is likely still an impending reality for us this year. The chart that you're seeing here is basically giving you a great visual illustration of some of the measurables that we refer to as leading economic indicators. And although this sounds like a lot of industry acronym and titling, it's really as simple as things that you and I participate in every day that, based on how much or how little they move, determine what is the status of the economy. Is it sustainable and strong and growing, or is it slowing and weakening? So a couple of the areas might be things as simple as building permits. Are new homes still coming about? Are companies writing new purchase orders? What is our importing levels? Unemployment claims. Those are some of the basics that are constantly looked at month over month to allow us to start to get a snapshot of what is happening around us. Now, one of the things you'll notice straight up from a visual perspective is everything above the line is considered a period of growth and expansion. Everything below the line would be considered a recessionary period. Now, as you're looking at this snapshot of roughly 50 years, it's basically one of the initial observations that could be very much glass half full is that the growth and expansion periods are classically wider and longer than those recessionary periods that follow them. So one of the things that our hope tonight is, although what goes up must come down eventually as part of the cycle, that classically it is not as long lasting, and there is wonderful opportunity on the other side. Now, one of the reasons that we circled in red to the far right is, as you've noticed in the past, sometimes you will see moments where these indicators will dip below the line and then for various reasons bounce up. Certainly, even during, COVID, there were moments where things were trending down and then turned around and went back on course again. But why we feel so strongly that at this point recession is very much in our likelihood later this year is because the level we have now achieved below the line of approximately 6% is, if you look across the line to your left, every time it has gotten at least to that level, it will continue on its path into a recessionary period. So could we be wrong? Certainly. However, at this stage, we feel pretty confident that this is going to occur, but looking at glass half full again, on the other side, if you look at the incredible growth opportunities that follow these recessionary periods, a lot of the rebalancing that Darren will discuss tonight and the positioning of funds in certain areas is being done for many reasons, not only for protective purposes, but also proactively to give us the opportunity to take advantage of new opportunity areas that ideally will be on the other side of a recessionary period.
Thank you, Audra. Super helpful. So again, the thesis behind why we're currently still being pretty defensive: inflation concerns, recessionary concerns, and third, kind of more anecdotally, maybe unknown dangers. And I guess the best and most recent example of that is obviously what happened recently with Silicon Valley Bank. Obviously, that dominated headlines for a good number of weeks. Certainly, the news cycles moved on. Things seem to have been stabilized in that realm. But I do want to make an important point that ultimately, what the Fed has done over the last 12 to 18 months is that they have raised rates from almost essentially zero at the beginning of last year to close to 5% in the realm of 12 to 18 months. That's historically quick, right? Basically, the fastest that rates have risen really for the last 40 to 50 years. And by design, the Fed raises rates aggressively in an environment like this because they're trying to tame inflation. And the way you tame inflation is by breaking something, okay? You try and break the consumer, or you try and break businesses, stop them from hiring as much. You try and slow down the economy, and that might seem really counterproductive and intuitive, but that's one of the main ways that you slow down inflation is through the rising of rates, which ultimately slows down other things and breaks things. And so Silicon Valley Bank was really one of the first visible cracks that we were able to observe as a pretty much direct result of the hiking of interest rates. The other really important aspect of this is that interest rate hikes don't generally, filter through, and their effects are not generally felt until honestly 6 to 12 months after the hikes have actually been implemented. And so my concern personally is, again, maybe potentially overblown, but at the end of the day is ultimately centered around the concern of, well, what else is out there that we just have not yet seen, right? That still, as a result of these interest rate hikes that have been going on, are now starting to filter through and starting to, undergo a lot of stress. I do want to take a minute just to kind of explain Silicon Valley Bank, even though it's somewhat of a news story that's kind of past, but it does illustrate just the link between how aggressively rates have risen and the pain that can put on certain companies and certain industries. So in short, Silicon Valley Bank catered very heavily to a very niche sector, which was really the technology sector, startup companies, venture capital, things of that nature. In general, over last year, 2022, in general, the tech sector was hard hit. a lot of layoffs, and just a lot of slowdown in new venture capital and the availability of money. And so deposits from their main, depositors and clientele started to really slow down. There was, word of trouble that started to emerge. And obviously it's a very close-knit community. So if one venture capitalist texts his founder, who texts his friend, who's a founder of different companies, and basically it was a good old-fashioned bank run, in the sense that depositors rushed to withdraw their funds. Here's the big kicker though, second bullet point from the bottom. Silicon Valley Bank, in order to meet these withdrawal requests, were forced to have to sell bonds at a loss, right? I'm going to talk about this. Bonds had large losses due to interest rate hikes. So here's the connection, right, between, again, the intensive raising of rates and how that actually filters down to actual companies on the ground. This is a really simplistic overview, but I think most people really don't have a great understanding of how bonds work and why they're impacted by raising and declining interest rates. So this is ultimately what happened with Silicon Valley Bank. They bought a high quality US Treasury bond, right, in this example. And again, for bonds, your main concerns are really default risk. Is the person that I lent money to going to go bankrupt and going to be able to pay me back? And really interest rate risk. And there's a number of different risks beyond that. Those are the two main ones for tonight that we're concerned about. With the US government borrowing it, generally default risk is really low because they can kind of print money and pay you back. Obviously with the debt ceiling stuff coming up, this may not age well. We'll see what happens. But ultimately, the US Treasury is generally a relatively safe person to lend money to. However, interest rate risk is still a very, very significant thing. And as interest rates rise, bond prices tend to fall. The simple explanation for this is that if I own a bond that is paying me 3% per year of interest, so I buy it, it's paying me 3% a year, it's not a bad deal. However, if rates rise and now the new bonds that come to market are paying 4%, if I want to sell my bond that only gives 3%, but someone can go out and buy a 4% bond, how do I make it attractive? I have to reduce and discount my price, okay? And that's why bond values and prices go down as rates rise, because the new issued bonds that come to market are more attractive than the old ones. The opposite is also true in a declining rate environment, where now if I have a 3% bond and now rates are now 2, suddenly my 3% bond looks more attractive than the current going rates, and people are willing to pay me more for that. So again, understanding the relationship between these two things is really important. And so as interest rates went up really, really quick last year, you start to get this massive issue where ultimately banks and investors in general are sitting on significant losses because ultimately the value of their bonds have gone down. Now, that doesn't really matter unless you are forced to sell the bond, right? Because remember, if you hold it to maturity, that bond is still going to pay you out what you expected it to pay you. You'll get your money back. But if you're forced to sell it as Silicon Valley Bank was, that's where you start to run into problems. And so if you look at this chart, just in very simple terms, this is as of the end of 2022, ultimately the unrealized losses on the underlying bonds that banks were holding. These are banks that are FDIC insured. And you can see this is kind of a little bit of a concerning chart where ultimately the unrealized losses on the collateral that these banks and the investments that these banks were holding were significantly underwater. Again, that does not matter unless the banks are forced to have to sell them to meet redemptions or to do something else. However, it does certainly point to a pain point and a very direct correlation to a specific deficiency and a specific pain area and risk caused by the rapid rising of rates. So for me, although there's a lot of programs now that have been put into place that should really help to kind of smooth over this particular problem, banks are able to borrow money from the Fed at a very appropriate rate. There's a whole lot of interesting programs that I think have certainly mostly reduced the risk over here. However, I just have to ask myself, we see this risk now, it's come to light, but are there other things lurking that we've not yet known? And ultimately risk is, if everyone knows about a risk, it's not really that risky. risks that we don't know about are the ones that we have to be a little cautious. And in an environment like this, that's been so tumultuous and there's been so much change going on, coupled with the other things that Audra spoke about, just makes me want to be a little bit more conservative, at least in the short term. Feel free again, Q&A, submit your questions. Happy to answer them as we go. But let me talk a little bit about 2022. I've referenced a few times tonight. It was a really tough year. Stocks were down. So the S&P was down about 18%. Bonds, if you told me, Darren, I don't want any stocks, they're too risky, put me in high quality US bonds, you were down 13% for the year. Just brutal all the way around. So, ultimately, we traded a lot more than we normally do in trying to position clients a lot better. And so a couple of things that did work really well was the overweighting of deep value stocks versus growth. So technology stocks tended to get really hurt last year. We were very heavily exposed to the value side of the equation, which really helps. We had a lot of commodities exposure. Commodities were one of the very, very few parts of the market that went up. And the reason that they went up was because inflation was pushing up prices of raw materials like wheat and soybeans and corn and beef and things of that nature. We were very short term on our bonds. One of the things that helps you to reduce losses in a rising rate environment with your bonds is to have very short term bonds. And so ultimately we were very high quality short term, which worked well. For bonds, we used a lot of market neutral positions, a lot of hedged positions, and we increased cash in February, kind of around the time of the Russia-Ukraine issues, which certainly helped to bolster things a little bit. So all of those worked pretty well in hindsight. What didn't work that well was actually gold. Gold in general, you would think would be kind of primed to do really well in an environment like last year. There was geopolitical concerns. There was obviously rampant inflation. But one of the major drivers on gold performance is the strength of the US dollar. If the US dollar is rising, gold tends to really struggle. If the dollar is falling, gold tends to do better. And last year, the dollar was really strong. And so gold didn't do as well as we'd hoped. And then most of you might remember that we implemented what's called an inverse fund about the middle of last year, which ultimately tends to act as a mirror image to the S&P or the stock market. If the market goes up, that goes down, and vice versa. We didn't lose a lot of money on that, but it also didn't add a lot of value because really from July through December, the market was pretty flat overall. So again, we sold out of that in our most recent rebalance. Let's look at stock positioning considerations. So kind of going into this period of time, what were we looking at relative to the stock piece of our portfolio? And then we'll look at the bond piece. This is kind of helpful because what it does is help us to understand the types of stock sectors and the areas of the stock market that tend to do well in different times. Generally we kind of lump the whole stock market together. We say the S&P 500 or something like that, but there's a lot of different nuance between that. And so there's certain types of sectors and stocks that tend to do well during different inflation and different economic growth environments. In higher economic growth and lower inflation environments, information technology, so technology, consumer discretionary tends to do quite well. I would argue that we're really not probably in that type of environment right now. We will at some point be again. These things move in cycles. But I think right now is not necessarily the time to be overweighting technology stocks as much as they've done fairly well so far this year. So higher inflation, higher economic growth, industrials, financials, materials. I don't know that we're in a higher economic growth environment, so probably looking to kind of underweight that area a little bit more. So I'd put us more on this side of the equation, probably lower economic growth in general would be my estimate for at least the coming 3 to 6 months. So in general, energy, utilities, real estate, consumer staples, healthcare, and communications tend to be the types of stock areas that we're mostly focused on right now. The other benefit of that focus is that these are also the types of sectors that tend to pay the best dividends. So in an area, in an environment like this, where the market's pretty sideways moving, goes up, goes down, but not really getting a ton of momentum, we want to rely on dividends. We want to be relying on cash flow and companies that are strong and profitable that can ultimately get us through the sideways period of time while paying healthy dividends, I think is an attractive trait to be had at this time. In terms of bonds, I think bonds are really interesting, and I haven't said that in probably 10 years, but here's the reality. Bonds got beat up really badly last year. However, bonds are more mathematical than stocks. Stocks are very sentiment driven, so they're driven by confidence and how do people feel? Do they feel optimistic or pessimistic and things like that, at least in the short term. Bonds are a lot more mathematical. They're issued at $100, they mature at $100. What happens between point A and point B can be anyone's guess, as we saw last year, but the reality is par value is $100, right? So that means a bond is issued at par and it matures at par. Right now, if you look at the bond market, if you look at these blue bars, that's where the average current price of bonds in these different sectors of the bond market are trading. So I'm going to focus in on core bonds, which are really just going to be solid quality US bonds, corporates, treasuries, things of that nature. And you can see that the average price of bonds have come up a bit since the end of last year, but they're still trading just over $90 on average. So what that means ultimately is that if we buy that today, as long as the issuer, the person that's borrowing the money, doesn't default and go bankrupt, and again, if you're buying high quality stuff that's already low risk, ultimately you're going to get that appreciation as the bond gets closer to maturity at 100. So you're going from 90 to 100. Plus, in the interim, you're getting paid a lot better interest rates than we ever were. So now you can find some pretty attractive looking high quality bonds that pay roughly let's call it 4 to 6% in that range, with pretty minimal risk and very, very attractive outlooks moving forward. So part of our reasoning for wanting to be more defensive right now is because, number one, I don't look at the stock market and think it's overwhelmingly cheap. I think it's actually pretty fairly valued to maybe a bit expensive. And finally, we have an option where we can get paid to wait for things to calm down. We have things like bonds, money market accounts, CDs, things like that can actually pay us while we wait. And I think that that's really attractive, right? During average recessions, you can also see how different bonds have performed over time. Long-term, intermediate term, short-term tend to do, the best, while stocks and other more risky bonds tend to do worse. So again, I think this is kind of a sweet spot right now. If we're aiming to be, overweighting bonds, and that's one of the big things we did as we moved into this quarter of rebalancing. I'd like to take a moment, if I may, and get a little bit nerdy with you. I can talk about this stuff all day, but I realize that most people on this call have zero interest in really getting into the weeds. But I'm excited about this because I think that this is really exciting, and it gives us a couple of really interesting tools that we can really use effectively in the current rate environment. In the current environment we're in, which is it just kind of sideways moving, not a lot of momentum, possibility of things doing well, but also a lot of possibility of things doing badly, just really uncertain. And I think that these are really interesting tools. So what I'm referring to already, our top portfolio idea at the moment, which is called buffered ETFs. You would all likely be familiar, if you've been with us for any length of time, of something called hedged stocks or hedged equity funds. These are funds we've used for many, many years. And buffered ETFs are effectively just hedged equities, right? Equities are stocks, so hedged stocks. What do I mean by hedge? What I mean by hedge is ultimately when you hedge your bets, you're trying to reduce risk, right? You're trying to ultimately aim to not take on all of the risk. And in exchange, you generally give up something in order to hedge your bets. So these buffered ETFs, I'm going to show you two different examples. One of how they work in a down market and another in how they work in an up market. And I'm going to show you the pros and cons because nothing is always, without cons. So let's take a look at how these generally work. Firstly, buffered ETFs are generally going to run in a calendar year. So you might have a January to January interval. So you ultimately can predefine the time frame in which this buffered ETF works. And thereafter, it kind of, rolls into the new vintage, I suppose is a good word for it. So let's look at this here. This is an actual performance of an actual ETF, the types of which we're using now. And this is from January 24th of last year to January 20th of this year. So a 12-month period of time, January to January. And as you issue it, you basically, from the beginning, predefined what your upside cap is. In other words, the maximum that you're able to earn in that particular position. But you also know where your actual protection from the market decline is. So you get buffers of all different depths. You get buffers that protect you from 0 to 15, 0 to 10, -5 to -25. You can kind of structure it how you want to do it. But in this scenario, this is a buffer that's a -10% buffer. What does that mean? What that means is that from the day that you are issued, ultimately, you know exactly if the S&P 500 moves down and loses 10%, ultimately, you are protected in that first 10% drop, and you will not participate in that at all, right? If the S&P continues to drop down through the -10 and goes down, let's say to -20, you will effectively be down -10 because you were out for the first 10 and in for the second, if that makes sense. So that sounds pretty good, right? Ultimately, this is an example of one that worked pretty well. The gold line is the S&P 500, and you can kind of see how it, broke down through the -10 and ultimately ended down about 10% for that period of time, whereas this particular fund in blue ended at pretty much 0, which is where you would expect it because the protection kicked in. Now, that sounds great, right? So, okay, Darren, so you can protect yourself from the first 10. There's no issues. Why wouldn't everyone do it? Well, the reason you wouldn't always do this with all of your money necessarily is because you are capped on the upside. So again, from when you buy it, you know where your downside protection runs to, but you also know where your upside cap is. And so this is a good example of November 2020 to November 2021, when the S&P did really, really well. And ultimately, we got capped out at about 14%. Whereas the market was up 30. Okay, so that there is the con. That's the drawback, that ultimately you're not going to necessarily get all of the upside of the market. But if you look at these tools as effective tools for helping to manage risk, most people aren't going to be too upset with being up 13.7% for the year, as long as all of your money is not necessarily in there. And I think that they're really helpful tools for helping us to manage this downside risk that I think is very, very possible in the next 3 to 6 months. So we've implemented a lot more of those than we typically have. And I think that that's an appropriate idea for the current environment. So as we bring this in for a close, recent model changes that have just been implemented the last couple of weeks. And I'm going to break it out into stocks, bonds, and alternatives. So on the stock side of things, we've increased international stocks a little bit. We were very underweight international the last number of years, which has been helpful. And we're still in no way overweight international. However, we've reduced the underweight and we've increased international stocks for 2 main reasons. Number one is that valuations in the international stocks are really, really cheap in comparison to the US, and they pay really, really good dividends. And right now we really want cash flow. Number two is that international stocks like gold tend to do better when the dollar is weakening. And that is definitely the trend line that we're seeing right now. So again, slight increase in international stocks. Number two, replacing our large growth holdings. So this is an interesting, lesser known thing, but we for a long time have held a large growth holding. That's an ETF that really tracks the S&P 500 growth index. And it's done very well, exactly what we expected to do. But what people don't really understand is that ETFs that track indexes, there is a company and there's a set of decision makers that decide which companies make up any given index. And so, at any given time, the S&P 500 is actually determined by the company S&P. They determine those 500 or so companies that are actually going to be in that index. And so what happened towards the end of last year is that the S&P 500 growth index was reconstituted and reworked. And it meant that suddenly you had a lot of companies that were traditionally value companies and dividend payers So companies like Exxon, Johnson & Johnson, Chevron. So those types of companies that were traditionally in the value category were now finding their way into pretty high weightings in the growth indexes, because of ultimately a couple of different rules behind the decision-making process. So again, those are the kind of nuances that we're always kind of trying to keep track of for clients and making sure that we have the exposure we think we have. And so we replace that then with this position here, which I think is a better representation of the types of sector exposure that growth should really be giving us. And we also slightly reduce the overweight towards large US value stocks. We're still overweight value, because of that grid I showed you earlier. In lower economic environments, that's a better place to be. However, we did slightly reduce that overweight as those stocks did so well last year. On the bond side, I've talked a lot about bonds. We have increased duration. Duration means that you're holding longer term bonds, right? So we were very, very short term. Now we're extending that a little bit. Still not long-term bonds, but we're definitely more on the intermediate side. For those of you who follow duration, we're probably around 4.5 times or 4.5 years duration at the current position. So I think that that's going to help us moving forward to really take advantage of the bond returns. We rebalance market neutral and ensured adequate cash in place. In an environment like this that's uncertain, been having a lot of conversations about, Darren, what changes do we need to make? Do we need to make any drastic moves? And the reality is, even for folks who are in retirement, living off their money and taking distributions, the main risk is not that your account goes up and down in value, right? That you open your statement and you see a lower number than you did before. That's not the main risk. The main risk for retirees living off their money is not having access to the cash they need when they need it without having to sell something at a bad time. You can think of Silicon Valley Bank in that example. They would have been fine if they didn't have to sell their stuff to give people back their money. It's the same thing with retirees. So if we ensure that we have adequate cash in place, that's going to go a long way to helping us to ride through any storm that we encounter, and knowing that we don't have to, sell anything in a knee-jerk reaction to free up cash. And that also means that it's important for our clients to let us know ahead of time, as you know, of potential upcoming large expenses. If you know you're going to need a new car in the next 3 months, a new roof, those are the types of things that are helpful for us to know, so we can try and plan around that and be strategic about what we sell when we sell it for you. Lastly, the alternatives. We did a lot of changes here in the last quarter. We sold some of our more traditional hedged equity positions that we've held for a long time. We sold the inverse fund, which I mentioned. We purchased some of these Buffett ETFs that I just gave an overview on. And we increased a holding we have called JEPI. That's a very, very high income focused producing stock position. We also reduced positions in commodities, which might be a little bit counterintuitive because commodities did so well last year. But the reality is, I think a large part of the commodity spike was obviously driven by this massive inflation spike. And while I don't think inflation is necessarily just going to roll over and disappear tomorrow, I also don't necessarily think that another one of those spikes is probably imminent. And so I think a large part of the gains in commodities have likely already been realized to a large degree. And there's probably better, lower risk places to put money where we can still get reasonable returns and kind of book those profits, for lack of a better word. And then we increased gold allocation up from 3 to 5. Gold, again, tends to do better in a weakening dollar environment, which I think is quite likely we're entering into. And it also acts as a nice hedge against things if things go really badly. So all in all, I hope that that's a helpful overview. Audra, why don't you talk us through just kind of a couple opportunities, and then we'll certainly open up to questions. In the meantime, if you have questions, please type them into Q&A or even raise your hand and we can allow you to speak on the call.
Great. Well, we know you guys have been given a lot of information tonight, but the last slide, we really wanted to appeal to those of you, again, back to our planning, is looking for opportunities when there's certain things we aren't participating in, there's other things we can. Now, after almost a decade of flat or negligible interest rates, it's not a great time to take a loan, but it certainly is a fantastic time to think about savings. And there are some wonderful opportunities that we are finding in CDs and fixed annuities. Certainly, don't confuse fixed annuities with variable annuities. They are a different vehicle. They are more parallel to a CD in the way they are structured. Also, as Darren was referencing earlier, bonds, there is a wider diversity of opportunity now with bonds than there has been in quite a number of years. And along the way, please know that we are constantly looking for new opportunities and ways to get back into stocks and bonds. So as you're seeing, even by the models and the way they have been positioned, we are holding more in money market. There is inherently a better return opportunity. And with that positioning, we can not only satisfy your short-term needs that maybe are unknown tonight, but a month from now, something may pop up. And we really want to make sure that we have opportunities. So for those who have maybe been setting aside and spending less, certainly coming off of COVID, we were approached by a lot of individuals that had discontinued activities and had amassed a greater level of cash reserves. These are some nice, relatively liquid opportunities where you can harvest some better returns that might be available in your local banks. So please reach out to us and we're happy to share. As again, these are moving targets, so rates do fluctuate from day to day, but we're happy to share information about them.
Awesome. Thank you, Audra. We'll certainly open up to any questions. If you want to raise your hand and want to talk, that's certainly available. If you want to submit a question typed through the Q&A section, please feel free to do that at this time. So an anonymous attendee, I have some extra money. Should I invest it or pay off debt? That's a really difficult question to answer in general terms without knowing more about the situation, the type of debt, the rates on the debt, things of that nature. It's really difficult to answer that. But I do in general, you want to factor in a couple of different things. You want to factor in, obviously, what's the interest rate on the debt? What kind of rates do you think you might reasonably earn on the money that you invest? Are you able to, safely earn a level of return greater than the interest rate on the debt, or are you going to have to take a lot of risk in order to earn a greater return? And obviously, how does that factor into your broader plan in terms of, if you're getting close to retirement and, should I be paying off my mortgage, which will free up more cash flow? Probably yes. So there's a lot of different ways to answer that. Certainly, if you want to pin us after this, we can talk through that in more specific terms for you. Judy asked, any thoughts on I-bonds? That's a good question. Yeah, so I-bonds last year, which for those who don't know, are basically inflation-linked bonds. They kind of pay a very nominal rate, but then most of their rate is really tied to inflation. So as inflation last year was kind of hitting those 9% rates, as Audra kind of showed early on, so kind of up here, there was a whole scramble to get into I-bonds because they're paying 9% or so. And that's really, really obviously very attractive. But I do think obviously their attractiveness is certainly waning to a large degree. That 9% is not a fixed rate. It's floating and variable, and it gets adjusted downwards periodically. And so I think the latest, I don't know this for sure, but I think the latest print I saw on I-bonds was that their interest rate have definitely come down pretty significantly, maybe closer to the 5 or 6% range, which is more now traditional bond territory. And so I think if you have the opportunity to lock into another bond at that same rate that isn't floating, because I think the longer term trend of inflation over the next 12 to 18 months is still continuing to go down very likely. They're not unattractive. I think there's probably now some better opportunities though. Dave asked, if we were investing with a 20-year horizon, would you be as excited about fixed investments like CDs, or would you be looking more to equity investments? 20+ year horizon, equity investments all day long. I think at the end of the day, that you raise a really good point. It's all about time horizon. I think for people that have cash on the sidelines, that they're really kind of just waiting, they're not intending to use and not intending to put into the market at any point, CDs are a fantastic opportunity because you're earning more than you otherwise might. But for anyone with a longer term view, the ability to withstand volatility, ups and downs in the market, I do think that, equities in general historically have turned out to be a better long-term investment And again, understand that CDs have a limited time frame. So even if you lock them up for 12 to 24 months, by the time those mature and you have to reinvest them, it's very likely that a lot of the recovery in the equity and the bond markets have already been seen, and you're not going to likely do as well over time. That's a great, great question. This is great. We've got 3 more minutes. More than happy to take any additional questions. Ed, you asked the effect of ESG on banks. That's a tricky one. I don't know. I guess I'd love more clarity, I guess, on the question if you want to throw it in the Q&A for me. Your bank solvency, the way banks are rated, just would love some more info there to better answer that question. Christina asks, how do we get a copy of the webinar or any other information we have available? So we will be posting this as a coffee and cash video going out on Sunday mornings. If you're not signed up for Coffee and Cash, or if you don't receive them every single Sunday morning, Audra and I send out videos, generally 3 to 5, 6-minute videos on a variety of different topics about investing, finances, financial planning. So this will be this week's Sunday morning video. We'll have the link. You're welcome to share it with friends, family, colleagues. If you're not signed up for any reason or not receiving the Coffee and Cash videos, please feel free to email reception@simmonscapitalgroup.com, and Christine can get you signed up there. But that's a great question. Well, I guess the last thing that I would throw in, unless Audra, do you have anything else that you wanted to add?
No, I think we covered a lot of stuff tonight.
We did, and I'm sure everyone is looking forward to having a bit of a nap after this. But one last thing that I'd like to just throw out there is, we've gotten asked more and more frequently over the last couple of months, especially with all the turmoil going on, just from existing clients kind of coming to us and saying, hey, my kids or my grandkids, have these questions about their own, retirement stuff, or maybe it's student loans, or maybe it's how to pay for college, whatever stage of life they're in. Would it be okay if they could speak to you guys? And, even though they're not clients. And yeah, of course, that's absolutely always available. It's always an option. And in fact, we're actually going to be making available to really anyone something called 20 minutes Ask Anything sessions. Ultimately, 20-minute Zoom calls that people can log on with us. We can just get down and dirty really quickly, answer a ton of their questions as it relates to, maybe their loans or their retirements or their investments. And so that's a free service we'd love to extend to you if you wanted to extend that to your friends, family, kids, grandkids, anyone that you think would maybe benefit from that. So if that's something that you're interested in, please, again, email myself, Audra, or even Christine at reception@Simmons Capital, and we'd love to help you on that. And that's about it. We're at 7 p.m. Really appreciate all of your time. Thank you for spending your night with us. And please let us know if you have any questions at all. We'd love to help you out. Thank you so much. Have a wonderful night.
Thank you. Good night.